Hey gang, welcome to Origination Nation. I'm your host, Chris DeMatteis, here with my main man, Steve Carvajal, and we are so pumped to have you with us today. Origination Nation is all about two things, relationships and collaboration, because that's what drives real results and success. In every episode, we sit down with leaders from across the industry who are doing things differently, bringing bold ideas to life and making a real impact. All progress originates with great ideas, and this show is about sharing what's working so others can learn, grow, and build something that lasts. So if you're all about connection, collaboration, and helping others level up, you're already a part of Origination Nation. So let's jump right in and see what we can originate together. Hey everybody, welcome to Origination Nation. I'm your host, Chris DeMatteis, and I am stoked today. I'm here with my main man, one of my dear friends, and one of the top originators in the country, Mike MC Carvajal. What up, Mike? How you doing, man?
Good to meet you online, my boy. The World Wide Web is a beautiful thing. So thank you for having me on our Origination Nation. I love it, man. It's
yeah, man. I've been excited to do this for so long and get you on here. This show, as you know, is about just sharing ideas, best practices, what's working for people in their different industries, and just collaborating together, to help drive success for everybody. So you are one of the most successful people that I've ever known or met in the mortgage industry. And it honors me to say that, though, man. I remember years ago when I got into this business, when Steve, our dear friend, coerced me into moving cross country back from San Diego to join the mortgage industry. That's a story for another day. But
San Diego to Jersey, that's a sell. Correct.
Yeah. Oh, yeah, man. But he was like, I'm working with Mike Carvajal. And I said, you got to be kidding me, dude. Mike Carvajal? I'm like, now I got to second guess this move, dude. But no, yeah. I'm kidding. But it was an awesome decision for me. But I would love to hear your story too, because you were already in the business when I got back here, and you were successful. You and Steve were killing it already, and that was back in 2008 when I moved back. But when did you get into the business, and how long have you been in it now? Give us a little background on your origin story.
So yeah, my story again, Chris. I've known you since '91 when Chris had long, flowing black hair. I mean, he looked like a freaking Greek.
Well, I still have black hair, by the way. I just want to throw that out there. It's not gray, man.
You and me both, my man. But yeah, again, I'm from Long Beach Island, and I went to college, and I left college, surfed for a while, and then I got my act together. I started working at Merrill Lynch, and all the while, I knew you. I knew Steve Carpatella, who's the owner of Informed Mortgage. I knew you guys just from surfing and, having the occasional beer and getting into some tomfoolery. And we always kind of kept in touch. You moved out to California. We kind of lost touch. But Steve and I, to a good extent, had kept in touch through college and so on and so forth. So I was working at Merrill Lynch. I was going through the motions. I took my licenses, my Series 7s, my Series 7 and my Series 66. I was well on the path to be a financial advisor. Didn't really align with me. My grandfather was a financial advisor back in the 60s. He told me that's what I needed to do to make money. Back in the day, that's how it was. The time was 2001. I started doing Merrill Lynch in end of 99 or 2000, I should say. I was in it for a couple of years, and I just didn't really like it. I was working a side job at this illustrious place called Barry's Do Me a Flavor. I was scooping ice cream. And I was literally making as much scooping ice cream as I was at Merrill Lynch. So I knew there was an issue, but Merrill Lynch kept telling me, stick with it. One day you'll be, a well-to-do financial advisor. So one night I go out to the Marlin, which is a local bar in Beach Haven. I was by myself. I wasn't with my girlfriend, who is now my wife, Vanessa. I just went out for a drink. And I saw my buddy Steve at the bar. Steve Carpatella, again, he's the owner of Informed Mortgage. He's one of my best friends. At the time, he was just like one of my acquaintance homies. Well, his mom had passed recently at the time. She passed of cancer. And, I have had cancer in my life. My mom had cancer. My grandmother passed of cancer. So cancer sucks. And I saw him, and I walked up to him. I'm like, brother, I heard about your mom, man. Can I buy you a beer? Let's just chat, And we talked, and, he's sitting there, and he's like, what are you doing? I'm like, I work at Merrill Lynch. She's like, well, how do you like it? And I'm like, I want to eat a bullet. Like, I hate it. You know, I have to wear a suit and tie every day. I have to shave every day. I don't think I'm made for corporate America. And he said, Mike, I think that what I'm doing, you can do. So his story was his mother, unfortunately, got cancer. And his father had to stop working to take care of his mom, which means he couldn't make money, which means they started going down on their bills, which meant that at one point, not only was his mom, fighting for her life, but they were also fighting for their house. They were going to go into foreclosure. So Steve at the time was working as a CPA up in northern New Jersey, again, kind of in the same rat race as me, doing what we were told, live in the corporate world. And he had to make a decision. He needed to make money. And his friend that went to Rider College with him, Steve was a graduate of Rider, he said, look, I'm doing mortgages. And that guy was a total, I'm not Italian, but I married in. So he was a stunad, as they say. And if that stunad could make money, Steve figured that he could make money doing it. So Steve had been doing it about 6 months. So he said to me, look, I think you could do it. And I called my mom that night, and I called my dad, or the next day, and my mom said, don't do it. And my dad said, sometimes you got to jump from the boat to get to the shore, son. And my dad was from Colombia, South America, first-time generation, American citizen, the old one-way ticket. My grandmother gave him a one-way ticket to L.A. in the 50s, and he lived here forever, man. And so for him, he was like, go for it, So I did. I took the plunge. Steve and I started working together, and here I am 23 years later, and it's just been nothing but a blessing. I love what I do. With Merrill Lynch, I was selling a stock. I was selling a mutual fund. I was 22 years old, 23. I didn't know if it was going to be beneficial. I didn't. With mortgages, I know that I'm either helping you save money on a refinance, or I'm helping you purchase a home, or I'm helping you pay your mortgage off faster, or I'm taking cash out and you're doing renovations. That's really it. Like, those are the 4 things that I do that show benefit. So for me, it was tangible. For me, I could put my head on the pillow every night and going like, okay, I help these people refinance and save money and pay off debt, or I help this person buy their first home. And I was never really a math guy. I just, again, was thrust into this industry, and who knew? Like, I'm good at math. This math, mortgage math, like statistics and such, I'm not that guy. I'm not good at much, quite frankly. Don't ask me to change a light bulb. It's just not going to bode well. But with mortgages, I found a niche, and I love mortgage planning. So I took Merrill Lynch, all the stuff I learned at Merrill, and I brought that into the mortgage world. So that's my story, and myself and Steve have been working together. Again, you came on a few years later. Your brother's been working with us. It's really a family organization, in my opinion, of what we have going on at Informed Mortgage. And it's just, I feel blessed and lucky every single day. Like, I'm going to get a tattoo that says too blessed to be stressed, because I truly feel like I made it. I got lucky, and I'm in a job where I can make money for my family, but I can help people, and I can be at the soccer field. I can be in the water with the kids surfing, and I have the drive that if I need to work till 3 a.m. to make that happen, I will.
I love that, man. Yeah. And I think it's interesting that you started at Merrill Lynch in the financial advising world. And what you described that you do, and what we do as mortgage professionals, is essentially another form of financial advisory, right? Like, we're helping people structure their debts. We're working with credit, liabilities, assets, and helping them buy, like, what is oftentimes their largest investment in life. Yeah. Carries the biggest payment, impacts their cash flow. So, we have actually, you and I together have built a lot of relationships with financial professionals over the years, CFPs, financial advisors. And there's a synergy in what we do, because we are actually acting as financial advisors for our clients. And we're not selling stocks and bonds and life insurance. Like, we're only doing that one thing, right? Managing debt and structuring debt for individuals who are buying homes. Help manage their cash flow, consolidating debt. But it works hand in hand with actual financial advisors. So I always feel like, we are financial advisors. that strictly, focus on housing needs, right?
Special teams, in football, we're the special teams that just come out.
That's a great way to put it.
And we just deal with the mortgage side of it, which is your housing expense, folks, is the biggest debt that you have. Hands down. It's more than your Range Rover. It's more than your Winnebago that you bought. It's more than that sword that you bought online or the margarita mixer. It is absolutely 100% your biggest expense. And if that is out of whack, or if you have outstanding debt that's out of whack, how are you supposed to save for retirement, save for your kids' college, save for, again, you and I both got daughters, save for your daughter's wedding, bro? Like, that's on us.
She's never getting married, bro.
Yeah. Chivalry is not dead, and I am triple old school, man. Like, I'm going to pay for my girl's wedding, but like, how do you do that if you're drowning in debt?
It's a big concern, especially right now too. I mean, for those with kids, like childcare expenses are ridiculous. Health insurance, I literally have clients who pay more for their health insurance and their childcare combined than their mortgage payments.
Yeah.
So yeah, the cost of living is super expensive. Managing your housing payment and your mortgage payment is always something that factors into, the different stages of life, right? So, it's interesting to me. Like, as I've gotten to the business, I realized people are refinancing their mortgages on average every 3 years, right? Like, at first I was like, oh, a 30-year mortgage, you're going to get one, you're going to hold that forever and pay it off. That is absolutely not the case. There's literally, I think it's less than 3 years. The average time, a 30-year mortgage has been held over the past few decades. Interest rate cycles factor into that, but also, the stages that you move through in life, right? First time home buyer, getting a starter home,
sure,
getting married, having a kid. Now you need more space. You're upsizing, right? And then the family gets bigger.
You have another kid.
Right? Exactly, right?
You just took that one glass of wine, bro. And now we have 2 kids. I mean, you and I both bought our homes around the same time. You were smart enough to buy a single family. I bought a townhome, and then I had 2 kids, and I needed a bigger house. I couldn't build off the townhome, man. It was what it was. So
and I had one more glass of wine than you, bro, and I ended up with 3 kids.
You got a 3,
right?
Exactly. You have
3.
I have
3. I had to go build a new house. But
exactly.
But I'll tell you what, like the first house we bought, right, which we loved and was where we started our family, which we did outgrow. We lived there for 11 years. And it was owning that home for 11 years, right, and investing in home ownership and being able to generate equity that eventually sell that house, which gave me money for a down payment on yet a bigger house, right? So again, like, my mortgage changed yet again, right? So I got a new mortgage, and like, again, every 3 to 5 years, it seems like I'm replacing my own mortgage. My the point in life I'm at changes. And now my kids are grown. Your kids are a little bit ahead of me. Next phase, like college, right? Like, the cost of college is through the roof, and I have clients that are tapping in the equity, refinancing, pulling cash out at that stage to pay for school and other investments. So again, it's going back to being a financial advisor. That's really ultimately what we're doing, right? Is helping people manage their cash flow, manage their debts, and get through those different phases of life, and the relationship with the clients that we build is also important, right? Like, it's not just one mortgage, man. It's having that having that trusted relationship that with the clients is key, right? You want to touch on that, because I know that's how you have, and we have all built the business over the years. But I mean, becoming one of the top originators in the country, from a volume and unit perspective, like, it's not from just helping one person one time, right? Like, you're maintaining these relationships, right?
I mean, yeah, and that's where it really comes down to, you got to trust the process, right? So I use my life situations, things that have happened to me, good and bad, to explain my strategies. So for me, in 2007, 2008, I bought my first home. And then in 2009, the market tanked. And I was absolutely Catholic guilted about what I did. Again, I'm a mortgage planner. I'm the guy selling loans, everybody, right? And I was like, I should have rented. Why did I buy? Well, I stayed in the house. And like you said, I stayed in there, I think about 11 years, Chris, you're right. I think I stayed like at least a decade in the home. And what happened was every single month I paid a little bit down on my mortgage. Every single month my mortgage balance went down a little bit. And guess what? The market rebounded. It more than rebounded to where I sold my home for a $40,000 profit. And I put that into my, forever home. And having that behind me and being in this game almost 25 years, like gives me the intestinal fortitude to say, look, I've been through this. Like I know what the hurdles are. And, first time home buyers, it's gosh darn stressful, man. Like I feel bad for my kids. I feel bad for our kids going into this market. It is not an amazing market. You have a lot of the social media and media outlets just pissing on the housing market, talking about why you should rent. I think it's bullocks. Absolutely. You get a tax deduction of up to $10,000 a year for your property taxes and mortgage interest by owning a home. So I don't care if you make 25 grand or 250 grand a year. That is something, number one. Number two.
Yeah, they actually lifted that. You say, that cap's gone. Yeah, so now you can write off all your property taxes and all your mortgage interest.
I just learned something. I'm going to go tell about 1,000 people that today. So thank you for that. That is amazing. So say it one more time. There is no cap on what you can write off.
No. Yeah, they did away with that. The $10,000 limit has been removed. So now all of your property taxes and your mortgage interest is now tax deductible again.
That's insanity. Thank you. I didn't know that. See that? We just both learned something. I mean, that's one thing. And the other thing about it is, so let's talk about home ownership for a second. I can remember in 2008, 2009, when my house was worth less than what I paid for it, when I knew I couldn't sell it and get out from under it. And I would pull up to my house and it felt good. And the reason it felt good is because I knew it was mine. My wife and I would dance in the bathroom because we put 3.5% down. It was the only part of the house that we owned. And we would dance in the bathroom because that was our piece, right? And it made me feel good. And as fathers, as head of household, I think that it's important to have that. It's important to have that, little carrot in front of you, to know that you're doing something for your family. Like just like my dad, when he flew to LA one way, he wanted more for his family and he gave it. And now that's on me and it's on you and it's on all dads and moms, not taking away anything from moms. Again, I grew up in the single mom, Patty Howe. She is a boss lady and she put up with this. So again, kudos to you. But my point being, it's important. Home ownership is important more than just monetarily. Home ownership is important to help keep families together, to give you a sense of purpose, because if you're living in a rental and it's shitty and you're paying to have somebody else's house fixed, where's your head at? Where is your drive? I think that's tough, and I do have buddies, that never bought and now they're priced out. Now, I could go back and say, not really, because there's still time. So for all you out there, it's never too late to own a house. I still think we're about to go on an additional appreciation with rates dropping. And Chris, if you could kind of touch on interest rates, that'd be great. But I think that it's never a bad time to own a home, especially a primary residence. You don't do it to make money. You do it to live in it. A wise man named Mark Reynolds told me that one day. He said, son, you don't buy a home to make money, or at least a primary residence. You buy it to live in it and grow your family.
That's a really, really good point. Yeah, it's so true. You want to your point, like create a household, create the family, the memories, and we put money into our primary residences, right? We're constantly investing in them to make them even more comfortable, more user-friendly. And if you tally up all of the money that we put into our homes over the years, it does eat into the appreciation, right? And it limits the overall rate of return as an investment. But overall, it is a great investment for tons of other reasons. And I think a lot of people are on the fence, first time home buyers you touched on, who are waiting, everybody's waiting for something, right? So the point that your father made, sometimes you just got to jump off the boat to get to the shore, right? You just got to jump in with both feet. And it's the right time to buy a home. I get this question all the time. Do you think it's the right time, Chris? And my answer to everybody that asks me that is, it's the right time, regardless of interest rates, regardless of home values. It's the right time for you to buy a home when it's the need for you and your family, right? When it's right for you guys as a family unit, that's the right time to buy. And that time's different for everybody. But, the sooner you can jump into home ownership, you should, right? Because there are tax advantages to it. There is equity to gain with appreciation. And if you're renting, let's face it, the rental market's not very friendly right now. I mean, I have plenty of buyers who come to me who are paying $2,000, $3,000, $4,000 a month in rent. They're just paying someone else's mortgage. They're just paying their landlord's mortgage, right?
Yeah.
So it's definitely, something that if you can afford a housing payment of a few grand, you can afford a mortgage, and there's ways to structure it. There's programs, there's all sorts of tools out there for you, but a lot of people are just hesitant. So, I encourage them just to jump in, jump off the boat.
Sure. I mean, one of the programs that I wanted to touch on today was a non-occupying cosigner program. It is a home run. Chris, I know you specialize in them. I do as well. A non-occupying cosigner program is where a family member, it must be a family member, father, mother, sister, brother, aunt, uncle, niece, nephew, cousins, grandparents can non-occupying cosign. So what that means is if Chris or Mike wants to buy his first home, he can qualify for the low down payment option, which is 3.5%, 5% down, sometimes 3% down. And you buy it as a primary residence, but use your family to have additional income or to strengthen the credit. So if your credit profile is a little tough, if you have, virgin credit, as they call it, you just started opening your credit, you just didn't have a lot of credit. Or again, I'm born and raised here. You know how many of my homies are self-employed, landscapers, fishermen, roofers, again, you name it, restaurant owners, where they don't claim all their income, but they want to buy a house. Or I have folks that, for unfortunate reasons, they got kids that are sick and they need help from the state. And if they make too much, how's this for you? How's this fair? If you make too much money, then they pull your state aid. And I have friends and family that have kids that are special needs, that have kids that have pretty severe, stuff going on, stuff that, I thank God every day that I don't have to deal with that. But they do. And how do they buy a house? So can you imagine that, having let's just say, a severely autistic child who needs everything the same, and you have to leave your rental because your landlord sells the house out from under you? I've had that happen no less than 10 times in my career, where I got a call from one of my homies and they have a child that has special needs and their landlord's kicking them out.
It's tough.
It's awful.
Yeah, that's really...
Turn
your world upside down real quick.
Correct. Yeah. And I'm not going to bring up lenders' names, but most of these big outfits, your box lenders, they're not going to do a non-occupying cosigner program. They're not. Why? A cold call center is not going to do that. Why? Too labor intensive. You effectively have to work twice as the loan officer. You got to take 2 applications. You got to do 2 credits. You got to do 2 income analyses. But is that a word? But
yeah, I think you got it.
At the end of the day, man, it's probably 30% of my business on an annualized basis, where I'm helping first-time homebuyers that could never qualify because they don't claim enough money to the government, but they have a parent that has a pension. They get a grandmom that gets SSI. We're not looking for prom queens and prom kings here. We're just looking for people with a 580 credit score or better that can help. So again, I just wanted to reiterate that non-occupying cosigner program for folks is a dynamite program, and I recommend it to everyone, especially self-employed clients or people that have to, due to medical reasons, keep their income at a certain level. And it's not just for first-timers, by the way. So again, anyone could qualify. My mom could qualify if needed.
It comes in handy a lot of times, right? So, and you just said something that's real important. We have a lot of self-employed borrowers and people who own their own businesses, And look, it's great to own your own business, right? You filing your income, you're declaring your income on your tax returns. Your accountants are doing a wonderful job of, writing the expenses off against the income and ultimately minimizing your taxable income so you're not paying an arm and a leg in taxes, right? But at the same time, that's counterproductive when you want to buy a home, right? Because we're looking at your bottom line net income. So if you have a business and, you may make, really great money, 6 figures, but on your tax returns, you're only making 30 grand a year, 40 grand a year, maybe not enough to qualify for a mortgage, right? So in those cases, using a family member, like you're talking about, a non-occupying borrower or co-signer to come in and just lend their credit, lend their income. I have grandparents that step in. People always ask me, well, can grandparents qualify? All they have is Social Security and pension and IRA retirement draw. I was like, yes, absolutely. That's steady, stable income, right? And they're always willing to help out. So, that's a great tool and a great program that not many people know about. So I'm glad you brought it up. And you also mentioned the big box banks, a lot of people gravitate towards the internet. When they're thinking about buying a house or getting mortgages, everybody goes to the internet for everything, right? And there's tons of clickbait out there.
You to do, right? Just go on. Yeah. Click the, what is it? The rock or something? I don't know.
I say, they spend billions of dollars on internet advertising. They're putting out these interest rates, which are, going to be a point and a half lower than what we would talk about with somebody because the fees are through the roof. But it's great clickbait, right? But they are just trying to cast a massive net, scoop up 1 million fish, and they're happy if they catch a couple hundred. But the problem is in what you're talking about, the underwriting, right? The pre-approval process, like the actual time, effort, and energy it takes to figure out if someone can buy a home, right? That's not typically done by these big box banks until after someone signs a contract or after they get further down the road. Why? Quite frankly, because it costs time and money to do it, right? But if you're working with a mortgage professional that is going to invest the time to do that up front, right? That's when we'll uncover a problem. Like if you are self-employed or you don't have enough income, we can add co-borrowers into the file, right? We can explore those other options where most of the big banks are just going to have you fill out some info online, do a quick pre-qual and tell you, sorry, can't buy. And they just move on.
Here's the difference between the big banks, your call centers, and Chris DeMatteis and Mike Carvajal mortgage planners. The big banks and the call centers are just getting leads every day. They don't care about their consumers as much as I do. And I'll go on record saying that. Because every day they have 10,000 people calling them and they're coming in. And quite frankly, they don't have enough time, effort, or the energy. And most of them don't know, because many loan officers have been in our industry 4 years or less. They got in when COVID rates were really low, and now they're struggle bussing because they don't know how to actually structure a file. They don't understand how self-employed people work. They don't understand how non-occupying co-signers work. And Chris, you're absolutely right. The banks, those institutions want you and your realtor to go out, find a home, get under contract, sometimes even have a home inspection done, and then come to them, and that's when they underwrite your file. Chris, I can tell you that you and I have both made many zeros behind our name on the big banks fall through. It's pathetic. I love it because it allows us the ability to be the hero, to come in and to get it done. And I love winning. I don't care. It's not about the money. It's about like when you get that call at the end, like Mike or Chris, you guys made homeownership possible. Like when you're walking through ShopRite and someone walks up to you, like that's why we do what we do. But people ask me like, well, what's the difference between you and the big banks? That's it right there. Like you're a number, and if that's what you're looking for, then very much so be it. But for the biggest debt that you have in your life, why would you let yourself get treated like that? I'll never know that answer, but I'll tell you, it's a advertising facade. Those types of companies want you to do what? Not think, press a button, go to an app, and then you have a pre-qualification letter that means absolutely nothing. So now you and your husband are out shopping. You finally find the home in one of the toughest housing markets in the United States history, and now you're not approved. How's that feel?
But you got your hopes up, right? And you're hitting on like a really big problem with our industry, and it's The big banks, and I will say their names because they're the big guys, your Wells Fargos, your Chases, your Citibanks, Bank of Americas, they're also depositories, right? So I have my checking and savings accounts with them. And people just think naturally, I'm going to go to my bank to get a mortgage. But the tens of thousands of people that are filtering through their doors, with mortgage inquiries throughout the year, they just don't have the capacity, or the revenue to properly pre-underwrite and fully pre-approve all those buyers, right? So the banking community invented the pre-qualification process to protect their time and bottom line. At the end of the day, it boils down to time, right? And you hit the nail on the head. They can get a pre-qualification letter on an app or a website real quick, go to their realtor. Now they're going out showing homes, driving around. Everybody's investing time and money into finding a home. Only the seller gets involved, get contracts inked, and then you come back to the bank for the credit decision, right? And you find out there's a problem. So, we had a great idea years ago, right? Instead of spending billions of dollars on advertising and Super Bowl commercials and, football stadiums, what if we just did the actual legitimate pre-approval work up front, right? What if we found out whether you could buy a house and borrow the money you need to do that before you go out and look, before you sign a contract, before you waste a real estate agent's time, before you waste your own time? Common sense, right? But it's not done that way because there's a cost to do it, right? But Mike, touch on that. We created a program for that years ago. We've built our business on pre-underwriting people up front, getting that decision, right? And how's that worked out?
I mean, it's been amazing. I have upwards of 500 people in my client base that are actively looking for homes. Actually, I'm not going to say it's awesome because I feel bad for all those people. I wish they could all find homes. And selfishly, I wish I could lend them all money at once. That would be amazing. But that's just not how the world works, right? But, it's all the upfront stuff that we do to provide that. And when we send a pre-approval letter, I can always tell you that we're going to have a better result than a pre-qualification letter from one of those larger institutions. And another thing that we do as loan officers and mortgage planners and advocates, and what's an advocate? An advocate's a person that speaks for their client on whatever issue that the client asks them to and is not as good at. So if I go to Foot Locker and I'm asking the guy about my shoes, that's my advocate. If I go to the dentist and I go, my tooth hurts, he's my advocate. If I go to my doctor and say I feel sick, he's your advocate. But people don't think of mortgage people as advocates. People don't think of mortgage planners as advocates. That's exactly what we do. We advocate for our clients. So we're going to pick up the phone, and when you make an offer, we're going to call the listing agent. So any of you other loan officers out here, you want to know why I'm 54th in the country? You want to come get a piece of the MC? Come get it. I challenge every one of you. Every pre-approval that you have, call the listing agent and let them know, 1, how well pre-approved your client is, 2, that you're the person with the money behind it, 3, that you are there to answer any and all questions for not only them, but their seller, which, again, be a big boy or a big girl, put your money where your mouth is, have the seller call you and grill you on questions. I've done it all the time. I love it. I love it. And then lastly, let them know you're available. Are you a 9-to-5 loan officer? Well, then so be it. Tell them you're available 9-to-5. If you're Chris DeMatteis, Mike Carvajal, Steve Carpatella, Lori Disselkamp, Evan Beach, Herb Willis, any of the other folks working with us, we're 24/7, y'all. We are 365, 24/7. You can call me on Christmas. I may have a cognac in my hand, but I will take your call. And the bottom line is listing agents love to hear that. And that can and has been the difference of getting a client under contract, especially in a competitive market. You can't beat cash, but we're the next best thing next to cash. And at the end of the day, a financial advisor, Danny Kaplan, told me, at the end of the day at the closing table, if you're a seller, do you really care if it's cash? You don't. You just want your money.
All the money's green, right? All the money's
green. Green is green, son. So that's what I have to say on that.
Yeah, that's great. And, being available to help people is a big part of it as well. It's hard to get loan officers at the big banks, the internet lenders on the phone. So being available is a huge part of it.
They can't. They just have too many people coming in. It's like, again, you and I grew up in the restaurant industry. They work at McDonald's and we work at Capitol Grill. You'll both get fed, right? You both can get a hamburger, but which gives you the better feeling? Which takes care of you? And how do you feel after your experience? That's what we provide.
It's easier to skim the cream off the top when you have tens of thousands of people coming in, but it's not, not everybody is part of the cream, right? But that doesn't mean that those people can and shouldn't buy homes. And again, I just want to go back for a minute to the fact, and the investment that we make in underwriting these clients up front and actually doing a legitimate pre-approval, because it's important, right? And I think it's important for buyers to know this, and real estate agents and everybody else. Not everybody's going to be approved.
Versus pre-qual, if you could. Again, because you're
pre-approval versus a pre-qual. Sure. Yeah. And that word pre-approval gets used very loosely in the business, right?
Agreed.
It's thrown around, right? A pre-qualification is, I like to say, a scratch of the surface, right? It's like us having a conversation. Mike, what do you do for a living? How's your credit? Do you have money saved for a down payment? Yeah. How much do you think you can afford? Great. That's essentially a pre-qualification, right? I'm just asking you some questions. A pre-approval is really a legitimate pre-approval means that I'm making, as a lender, we're underwriting you and providing a credit decision up front before you buy a house, right? We're pre-approving you for the mortgage. We're underwriting your income, your assets, your credit. Instead of scratching the surface, we're lifting every stone, right? Because that's what's going to happen after you sign a contract. Right? You're going to go into the underwriting environment, and that's when the credit decision is going to be made. So doesn't it make sense to do that up front? Of course it does. Again, the banks don't do it because there's a cost, there's an investment to do it, and it would just be astronomically expensive to do it for everybody. So they invented the pre-qualification model. But there are lenders like us that will do legitimate bona fide pre-approvals, and it's important, right? Because one of two things is going to happen. One, the buyer's either going to be pre-approved for the financing. You're going to know going in before you sign a contract. The real estate agent will know that there's basically no chance, barring some appraisal or title issue, that the deal is going to fall through, right? So and that helps them solidify their offer. It makes them stronger as a buyer. So it's huge in that regard. But there's another part of it, right? And you used an analogy before, like, in relationships with a doctor, right? So going to a doctor, if you do go to the doctor and there's something wrong, when do you want to find out about it?
Sure.
Early, right away, right? You don't want to wait 5-6 weeks, right? It could be life or death, right? So if there is something wrong, we're going to uncover that through that underwriting process. And this is where I think there's a big distinction between what we do as professional mortgage planners and the big banks and the internet lenders that are skimming the cream off the top, right? Like, if there's a problem, if someone's not approved, and let's face it, not everybody is immediately approved, right? Instead of just shutting the door on them and telling them, sorry, you can't buy a house, we don't do that, right? We have a second program, we call it Almost Home, and it's been great for years, where we will actually hold their hand, right? Coach them through the problem and get them approved. There is no issue that can't be overcome with a little bit of time, money, or both.
We have seen it all.
But those buyers, right? Those potential buyers that come to us that aren't approved today, right? Again, instead of shutting the door in their face, we hold their hand, help them overcome the challenge. They become our best clients, our best referral partners. And for the real estate agents that we work with, it's building a future pipeline of business, right? That person may be approved 2 weeks from now, 2 months from now, or even 2 years from now. It doesn't matter. Eventually, they're going to buy a house. And along the way, we're helping them solidifying that relationship. And, that's been a huge success for us over the years. And it's my favorite part of what we do. I love taking someone who's not approved today, having that conversation with them, saying, look, I will guide you, right? I can lead the horse to water. Fair enough. We won't make them all drink, but the ones that do, they end up buying a home. And it's so satisfying for me to help them ultimately get into the home whenever that is. It's my favorite part of the job.
I can't make you pay your bills. I can't make you have a job. But what I can do is work with you and show you the way. And then it's on you. We all have a choice, right? Free will is a crazy thing, man. And if you do it, and the fact that I've been through it, the fact that you've been through it, the fact that we're family men and have just been through, a whole lot of insanity. We've been through, this is our 5th cycle of doing, rates up, down. We've been through one of the worst housing bubble bursts in United States financial history. Now we're in one of the biggest increases, 42% or more in appreciation in United States financial history. And yet here we are, and yet there's still options available. And yet the show must go on. So you're absolutely right. For anyone out there that has credit issues, for anyone out there that has doubts, for anyone out there that feels underserved, for anyone out there that just feels like the banks don't give a hoot, like, give us a shout. Call one of us at Informed Mortgage. We are more than willing to take the time, the effort, and the energy. And I never say no. I'm a yes man, straight up. But what I will do is not tell you no, and I'll tell you, look, here's what you need to do. And if you do that, it'll work. If you don't do that, then it's on you, though, right? Then again, I'm drinking coffee, and this coffee mug says, "Losers make excuses, winners make money." So I don't want to call a person a loser, but if you don't pay your bills, I can't get you a house, dude. If you don't go to work, I can't get you a house. But if you do those things, your credit can go from worst to first. I have seen it. I have seen sub 500 credit scores get a top tier deal as long as it took 6 months, 6 days. I worked with a guy for 4 years. I don't want to give his name away, but he was a Vietnam vet. He was a badass. He passed away recently, so God bless him and his family. But I worked with him for 4 years. I had to get him to a 620 FICO score. A veteran. Guy drove a motorcycle. He was a badass dude. Really, really good dude. He kept blowing out his credit cards for his family. His daughter got married. I had him at a 619 cuz I was right there. And his daughter got married, and he said, "Mike, I got to do what I got to do." And he blew out his credit cards. And I said, "All right, Mark, I'll stay with you, brother." And it was like another year. But I helped him get a house. And, that's the guy that would call me once every 6 months just to say hi. Like, that's the warm fuzzies, man. That's what I'm talking about. So, again, for all you underserved, for all you people that are just not sure, look, Chris and I are layman's guys. We're not rocket scientists. We're just normal folks just like you, trying to get by, but we're really good at this stuff. So use us for advocacy. Use us for all your questions. Use us and let us take the stress off of buying a home or refinancing. One of the things that I tell people is, look, I can't tell you not to stress, because I stress. I get it. Who doesn't have nights where you're looking at the ceiling sometimes going, how am I going to pay my bills? Or what's going to happen? Or someone's sick, or someone got hurt, or there's a cajillion things that could go wrong in your day. But taking the mortgage aspect out of it, and that's what I say. Let me worry about the mortgage. You guys worry about everything else. And I mean that wholeheartedly with every particle of my being.
Yeah, Mike, and you that story about the credit, credit is a big piece of the puzzle, right? We all say income, assets, and credit, right? Those are the three things we look at. It's not rocket science. Yeah, but we get tons of questions on credit. And I think it's worth, just touching on it real quick, right? Like the biggest influencer of a credit score is what?
Paying your bills on time.
Paying your bills on time, yeah. And what else, though, in specific? Like,
debt to limit ratios on credit cards, having a certain amount of credit, trade lines, things like that.
Bingo. Credit cards, right? So, like, we see every day people come in with low credit scores. Right on the credit report, it tells us what the potential improvement would be. It's almost always tied to revolving debt. So there's this myth out there, right? I can't tell you how many people I talk to every day who are like, well, and I tell them, you want to improve your credit? Pay your credit card bills off in full every month, right? It's simple as that. But then also make sure the following month you use the credit again, right? Charge more to the credit cards, right, and pay it off in full every month, right?
You gotta play the game. Right.
I say credit's like a muscle, right? If you don't work it out, it atrophies and gets weak. So you got to use credit to make it stronger. So many people use credit, and there's this myth out there that I don't know exactly where it comes from, but I just want to squash it, right? You do not need to carry a balance on your credit card from 1 month to the next. Not even $1. A lot of people out there think, oh, I gotta not pay my bills off, not pay my bills in full. I'm going to pay my credit card balance down to a few $100 and carry that over. All that's happening is you're being charged interest on the portion of the balance you're not paying off, right? It makes zero sense. If you pay the bill off in full, your credit score will jump immediately, right? And if you do that for 2 or 3 months in a row, you will see immediate significant improvement in your credit score. So just please stop carrying a balance on your credit cards intentionally. Look, sometimes you can't pay the bill off. It is what it is, right? Like, like you said, your client that daughter got married had to rack up the credit card debt. It is what it is. That's what it's there for. We use it when we need it. But if you don't have to carry a balance, don't pay it off in full every month. Use the credit, pay it off in full. Another big thing I see people do all the time is they use debit cards, right? Chris, I don't have any credit. I don't use credit cards. They're bad. Like, well, you want to borrow money to buy a house, you need to establish some credit, right? So stop using the debit card. Right? Get a small credit card, open it up for $300. I told my wife to do this when she was establishing credit. Look, she goes to Wawa every day and buys a cup of coffee, right? Literally every day. I should buy stock in Wawa. But I said, stop buying with the debit card. Just put all your coffee on this credit card and then we'll pay the bill off in full every month, right? She did that for 6 months and she had a 720 FICO score. So, it's really, really easy. Sometimes you just need to break the habit of spending cash or using debit. Just use the credit, use it wisely, use it smartly, and your scores will improve. But please don't carry unnecessary balances thinking that it's going to help your credit, because it will only hurt it.
Absolutely. 100%.
But so that's, I think it was, I just see it all the time, and it's a myth. So there's a lot of myths out there, though, and we can help people debunk these myths and coach them through, qualifying. So
speaking about myths, if we can just pivot for a moment, let's talk about home equity conversion mortgages. Let's talk about the dreaded reverse mortgage. You want to talk about myths? There's some myths with those programs. There's some myths that they're the devil. There's some myths that they take the senior's house. And again, your larger institutions are most likely not going to be able to facilitate a reverse mortgage transaction, also known as home equity conversion mortgage. Chris, I know you're an expert. I've been doing it for almost 2 decades. Let's talk about that for a second. The
4-letter word, right? The heck'em.
4-letter word.
It's funny, I have to be real careful when I breach the subject of a reverse mortgage with a client, because first of all, it is the most flexible mortgage program on the planet. And when it makes sense for a client, it makes a tremendous amount of sense. So much that nothing else really matters. They should proceed with the reverse. But there's this negative connotation out there about reverse mortgages. Like if I say to someone, hey, there's another option I want to discuss with you. It's a reverse mortgage. Oh, no. Immediately. No, I'm not doing a reverse mortgage. Absolutely not. No way. The government's going to take my house. It's a non-starter. And, so I got to be real careful when I ease into those conversations. And I don't say the word reverse mortgage, because the way I describe reverse mortgage is it's just another mortgage, right? Forget about the word reverse. Just focus on the word mortgage. It is. It's a mortgage, right? It's a debt leaned against the property. The only difference is with the reverse mortgage, the payment's optional, right? And it's optional. You can still make a payment on a reverse mortgage. You can make any payment you want. You can make a 30-year payment, a 15-year payment. You could send in $1 if you want, or $10. Right? Or you don't have to, right? Whatever you don't pay, the interest that accrues on the loan that month just gets tacked onto the balance, and the balance gets bigger over time, right? So instead of the mortgage getting smaller, it moves in reverse. It gets bigger. But if you don't have to make a mortgage payment every month, what does that leave in your bank account? Money, cash flow, right?
So you do with that money and cash flow.
Exactly, right? So like the reverse mortgages are a great tool for the right person that is looking to improve their cash flow. And let's face it, like people have paid down their mortgage balances over years. You have a lot of seniors who have a lot of equity in their homes, but they're living on Social Security, they're living on pension, they have limited cash flow. Their earning years are behind them. They're not making $10,000, $20,000 a month anymore. They're getting by on $3,000, $4,000, $5,000, $6,000 in monthly income, and they still have a $2,500 mortgage payment. What if we could just eliminate the mortgage payment, right? And they have tons of equity in the home. So that's what we do, right? We eliminate the mortgage payment, free up cash flow, and then their mortgage balance gets bigger slowly over time. But these loans, are great because they can't run out of equity anymore. It's very, very difficult, right? Like they used to give people way more than they do now, but now they can only access it
to be able to lend. But now it's on average, 45% give or take loan to value?
Yeah, 30 to 45. And interest rates factor into that, right? As interest rates have come up over the past few years, the interest accrues faster. So they give people less money, less access to their equity and there's a larger reserve. But those programs are absolutely fantastic when it makes sense, and I tell people all the time, it doesn't make sense if you're going to sell the house or you're going to leave the house within, the next few years, because you do have to be in the mortgage long enough for it to make sense, because the upfront costs are a little higher, right? That's what I'd say. What's the catch? What's the downside? Well, it's an insured loan, right? The FHA mortgage insurance is 2% of the home value. But, that could be expensive. But think about what that protects against. You can never be upside down in a reverse mortgage. You can never owe more than the house is worth, right? If you didn't make a mortgage payment, you lived there for 20 years and you ended up owing $1 million and the house was only worth $500,000 and you sell it. The government insurance is going to pay that difference. It's going to pay that $500,000. So you're off the hook.
Right?
Yeah, your estate is off the hook if you pass away. Is it going to become your kids' problems? No. The government insurance will protect your estate against having to pay more than the fair market value. In fact, the program will let you sell the house for 95% of what you owe on it. All right.
So, and let me read this back because it sounds crazy. You're telling me I can take a pill and I can live to be 1,000 years old. I can live in this house. I can outlive the equity. Let's say we go into a housing crisis and my house is worth $1 and I owe $1 million and I die. You're telling me that the government HUD is going to pay back the loan that is owed and that they're not going to come after my estate? Is that what you're telling me?
Yeah, that your estate will be able to sell the property for fair market value. Okay.
Right.
And so let's say, you owe $1 million and the house is worth $500,000. You would list your house for $500,000.
Right.
Get a buyer.
Right.
The bank would actually take 95% of the value as a payoff
to pay the realtor.
The other 5% would be left to cover the selling expenses for the estate. And the other $500,000 that was owed would be paid back by the FHA insurance. So yeah, you're off the hook.
No catch. Bank's always getting paid, right? And so
Yes.
That being said, if you have a life insurance policy for $500,000, they're not going to come after that now, are they, Chris?
No, right? They're not going to come after any assets.
The house is worth less than what you owe, kiddos, everybody in the sandwich generation, taking care of our moms and dads and our kids, and they pass, give the house back to the bank and keep whatever you got, life insurance, IRA, whatever mom, dad had. Don't go busting your cojones unless you want the house. Some people want the house for lineage and if it's a place down the shore or whatever, I get it. But if you have that situation where the house is worth less than what you owe when you pass, mortgage insurance protection is one of the best things I've ever seen in the market. So yes, it does cost money up front. It's not out of pocket. It's included with the loan, but that is a very, very powerful tool regarding the HECM, the home equity conversion mortgage, Chris. I have a story. Did you know that you can not only do reverse mortgages to pay off debt and refinance and take cash out? Did you know you can also do them as a purchase? I did it for my mom in 2018. My mom sold her place in Long Beach Island, New Jersey, in Beach Haven. She made a great amount of money. My grandfather bought it in the 60s. He was on the right side of the time. God bless Clinton Howe. Thanks, Pop, because he got me to the beach, and I would have never been a surfer without him. So my mom sells in 2018. She pays off all her debt because I love my mom. She's an interior decorator. She's super artsy fartsy. One of the nicest ladies ever. I mean, she birthed me, so God bless her. But she's not amazing with money, and she needed to have a nest egg to live on if she was ever going to retire. So we sold her house, paid off all her debt, And she bought a house on the mainland, a beautiful little ranch, 1,000 square foot. She walks in circles and paints clamshells, y'all. That's what she does every day, and she's an amazing grandmom. That's how life should be if you're a grandparent. Who doesn't want that? I paid off all her debts. I took $250,000, put it away for investing, and she put effectively like half at the time. She put half down. So again, a reverse mortgage purchase is where you put down whatever you need to for the down payment, and then you never have a housing payment. That is such an important tool that I am sure that seniors aren't aware of. So for all you seniors out there that are looking to downsize, but you're worried about what you'll do, take some of your nest egg, go give it to a financial advisor or self-fund it, do whatever you want to do, put it in a bond portfolio, CDs. I don't care. It's not my dojo, but take a reverse mortgage, not have a housing payment, pay off all your other debts, pay off your cars, pay off everything. And it is such an awesome opportunity for seniors. There are 10,000 seniors a day that are becoming 62 years of age. And it is a unknown and unutilized program, home equity conversion mortgage for purchases. And I literally did it for my own mom. I am telling you, it is awesome. It is not a bad deal. And you've heard it here first. I would never do that to my mama. I love her. And it's been a game changer for her.
Yep. Yeah. And, a lot of real estate agents aren't aware that you can do that. Again, just to keep it really simple, like you just put a big down payment down, right? It. So you're putting 60% down and you're financing 40% with a mortgage.
Same thing. As a realtor, nothing's changed. It's the same thing. So on the sales contract, you write it up as an FHA loan, right? You'd write it up as an FHA loan and the down payment and how much the mortgage is. So if you're buying a house for $500, you're going to borrow $200 or $250, and you're going to put the rest down. I'm just using some silly numbers. But as a realtor, it's nothing you even have to think about. You just ask us how much the mortgage amount is, and that it's an FHA loan, and that's all you need to worry about.
And then you have a $250,000 mortgage, and the homeowner, if they want to make a payment, they can. If they don't want to, they don't have to. And there's ultimate flexibility. Right. So, it's a great program. Again, guys got to make sure that they're going to stay in the home for a few years because they're financing in 2% of the home value for that insurance premium. But in the grand scheme of things, that's actually very inexpensive for the protection that insurance provides. So,
let's talk about
great program.
That. If you're in the home for a year, average appreciation in the United States, whether you live in Los Angeles, LA, California, Detroit, Michigan, or Long Beach Island, New Jersey, over the last 50 years, 4%. Your house goes up 4% every year on average, okay? So, and we just went up by about 42% over the last 5 years. So let's just use the 4% for conservatability. If you have to pay 2% the first year and you're in the house for a year, technically it's already paid for itself with the appreciation of your home on a 4% rule. Now, again, I still don't think you should take a reverse mortgage if you're going to sell in a year. But if you're going to be in the house for the long term, that absolutely will be overshadowed by the appreciation of your home. So again, growing up Catholic guilt, y'all, you don't need to have it. I'm telling you, because, and not for nothing, all you kids out there that says, well, I don't want my mom or dad to do it because that's going to lose all of the equity and that's my inheritance. No problem. Kick in every month. See how that feels. A couple $1,000 a month to help mom or dad. Oh, you don't want to do that? Well, this is a really amazing ability for you to let your mom and dad live with dignity in their own house. I just know the long term for my mom, she's going to end up having a nurse come to the house, as she gets older, and it sucks and it's morbid, but that's life versus having to sell the house, living in an assisted living facility when they don't want to. That's, again, why wouldn't you want to do that for your mom or dad? And I just think it's a very underutilized program, and I just wanted to chat about it today. Yeah,
that's it. One last point on that. It's a great way to help mom and dad. Also, we've had situations where the family wants to keep the house in the family. They want to protect the equity. I've had situations where the siblings have kicked in to cover the interest,
Sure.
and protect the equity. So you can make payments on a reverse mortgage. But, we could talk for hours and hours about so many different topics. Reverse mortgages are a great one. We teach classes on them, and we'll definitely have to get back on here and talk more, Mike. But, for the sake of time, we are coming up on the hour. I want to be respectful of everyone else's time. But, this has been, a lively, great conversation. It's been, awesome to have you on for the first time. And I know we're going to do this over and over again. So, thank you for setting the time aside to share with us and the viewers. And share the insights that you've had and what's been making you successful over the years. And guys, until next time, stay informed, stay connected, and keep originating. All right, we'll see you soon.
Carry on and keep going, everybody.